Great. I think we can get started with our interview remarks while we allow these additional callers to join. So first, I'd like to welcome all of you to the GSMA Mobile for Development Impact Research Webinar Series, which is being hosted today by Vital Wave. My name is Annie O'Connor, and I'm the Director of Professional Services at Vital Wave. For those of you who are not familiar with us, we work with leading foundations and corporations on scaling their businesses and programs globally. And what sets us apart from other professional services firms is that we specialize deeply in technology solutions as an enabler and on working in low resource environments, particularly in low and middle income countries. For those of you who are new to Mobile for Development Impact, GSMA supports the digital empowerment of people in emerging markets through its Mobile for Development, or M4D, impact program. The program delivers insights that are used to inform investment and design decisions for mobile services, and these are made freely available thanks to support from Omidyar Network and in partnership with the MasterCard Foundation. You can find these resources at gsmaintelligence.com/M4D. There's also a link to this website on the last slide of the deck. So today's presentation will focus on highlights from a recent report released by GSMA Mobile for Development Impact and written by two expert analysts from GSMA Intelligence on the topic of financing innovation. I'm thrilled to introduce our speakers, but before I do, just a few short housekeeping items. In an effort to minimize background noise, I've muted all of the lines, and the presentation is about 30 minutes long. We'll leave around 15 minutes for questions at the end. Since this is thankfully such a large call, we will only take written questions submitted via the web. So to ask questions at any time via the web interface, please go to the toolbar on the right side of your browser. You can submit a question at any point in this interface, which is marked question. A recording from this webinar will also be shared on the videos page of the GSMA M4D Impact site. And I just have to say that I personally really enjoyed reading this report, and it's a pleasure to introduce our speakers to you. First, I'd like to introduce Tim Hatt, who is the Head of Research for Emerging Markets at GSMA Intelligence, which is the definitive source for mobile operator data and forecasts. For those of you who are not familiar with this resource, it really does have the most accurate and complete set of industry metrics available. Since Tim joined in October 2012, he has been responsible for the team producing research reports and presenting externally at conferences and public speaking engagements. Prior to GSMA, Tim spent 6 years in London as an analyst covering telecoms and a variety of other sectors. Tim is joined today in presenting by Barbara Arisi, who is an analyst at GSMA Intelligence and was a lead author on the Financing Innovation Report. Before joining GSMA in April 2013, Barbara worked for Frontline at SMS in London and at Accenture in Italy. So with that, it's really a pleasure to turn it over to Tim to start us off. Tim.
Great, thanks very much, Annie. And I think that's an excellent prelude to the discussion today, which we're looking forward to having on an important topic, and one which I think has important implications not only for the investment community as a funding stakeholder, but indeed entrepreneurs and increasingly others, including mobile operators and public policymakers. So looking at the agenda, I'll start by running through the key takeaways that we identified in the report. I think there are four predominantly which are important to touch on. That will then lead into talking about the landscape of innovation in emerging markets, which is ultimately what we're here to talk about today and understand the opportunities for growth in that area. But equally, transitioning to the third bullet there, equally it's important to understand the investment challenges. If we're to move the discussion forward on growing innovation in a sustainable fashion, it's really incumbent, I think, upon the wider community to understand what sorts of challenges we are collectively facing. The unique data source for this report came from a proprietary survey that we ran amongst different types of investors. My colleague Barbara is going to take us through the methodology and key findings from that, which then flows nicely into a discussion of what is really, again, one of the unique points that we've come out of this report, and that's the role of the mobile operators. And the other stakeholder group I mentioned being public policymakers, who should really not be forgotten in this discussion for the integral role that they play. And then we will leave hopefully a good 15 to 20 minutes at the end for Q&A, as Amy mentioned. So, turning to the key takeaways, there are 4 key takeaways that I think you need to be aware of here in sort of framing this discussion and what to understand from it. And I'll spend a little bit of time on this as it's important. When you look at the overall investment space, I think the first key takeaway from an innovation point of view is that while there are increasing amounts of ICT investments in emerging markets, there are still noticeable barriers to developing what we might call self-replicating or sustainable entrepreneurial ecosystems. In other words, ecosystems that don't die once cash flow dries up from a single source, but rather replicate itself through a virtuous cycle of education, investment, mentorship, and ultimately success stories, starting the cycle again from the early stage. The 2 key challenges we see within that are that while investment is increasing, a lot of the emerging market hubs still draw most of their capital from abroad, be that in Africa, be that in Latin America, or even Southeast Asia, among others. Most of that capital is coming from abroad, and that has implications for the net value that an investor can provide, which we would include mentorship in and guidance, in addition to the straightforward capital. And the second challenge there is that there is really a lack of investment at the early stage, and by that we mean below $250,000, but particularly below $100,000. The second key point is that we think investors broadly face 2 key challenges. One is the scalability of the business model that they are looking at, and the other, closely tied to that, is around entrepreneurial business skills and experience. There is certainly no shortage of good ideas that have been put forth and indeed trialed in emerging markets in the mobile and technology space. The reality, though, is that there is still a very small minority of those as seen as having potential for lasting monetization, despite their evident social impact. And that's closely tied to the lack of business skills that investors tell us are lacking among the entrepreneurs who, from an otherwise technical point of view, are very solid. Closely tied to that, we say, what is not a problem? Well, actually, technical skills and the innovation that comes out of young entrepreneurs in emerging markets is not at all lacking. In fact, quite the opposite. There are a variety of educational backgrounds that we are seeing coming through, be that from engineering, computer science, even humanities, brought to the fore to bring ideas to scale. But what's really lacking is the know-how around addressable market sizing, around effective sales and marketing, sourcing partnerships and business development, and overall business execution. So that then leads naturally to the third key takeaway, which is, well, what do we do about it? And without being prescriptive, we think that there are important steps that can be taken both from entrepreneurs and investors to help improve the situation. From an entrepreneur point of view, quite obvious recommendation here is that we need to see an increase in business skills development and indeed their level of experience in the business market as opposed to purely focusing on technical concepts behind potential innovation. But closely tied to that, we need to look at investor behavior as well. And the point we would highlight there is that investment in ICT should not merely be seen as capital provision expecting a return. While that may be a model that has proved successful in maturing business hubs such as Silicon Valley, we think there is an important impetus to provide an enabling environment in emerging markets that includes mentorship and education beyond capital provision, and that really links into the entrepreneurial barrier of developing a business skill. And then the fourth key takeaway is that whilst in Silicon Valley, a lot of the innovation we have seen over the last 20 years has come from internet players and tech outfits, it's actually mobile operators that are at the fore in this space in emerging markets. And why do we think that's important? Really, it's for two reasons. One is that operators have a unique local presence on the ground and local know-how with the customers that new businesses are purporting to serve, and they can leverage that with entrepreneurs. The second is that entrepreneurship in emerging markets and the business model propelling it is much more of a hands-on affair, given the lack of cloud-based infrastructure and other infrastructure that enables businesses in Silicon Valley and others to largely be run out of one shop. The ability to provide network sandboxes for testing, combined with mentorship and that local know-how, we think positions operators very well to be leaders in the innovation space across the developing world. So those are the four key takeaways. Just turning now to the slide entitled Innovation in Emerging Markets. So as you will have seen from the report, if you've read it, is that it's very clear Silicon Valley has long been a leading center for innovation. That goes back 30 years to the days of Apple starting and Intel, and then a whole host of others through the late 90s, and then transitioning into the 2000s, where businesses who had originally profited from a largely fixed-line internet world had to make a transition into mobile. Of course, Facebook and Google are well known, but there are many other smaller outfits, particularly in the app space, that have grown. But the interesting thing is that we are now starting to see a number of other hubs around the world. We highlight a few in Europe, London and Berlin in particular, but most recently in emerging markets. And if you look at the chart on the right, you can see the red bars representing emerging markets starting to grow really over the last sort of 2 years. This is a crowdsourced view, but indicative of the underlying trend. There are a number of reasons for this, and that innovation is going to continue to grow in emerging markets. Mobile internet penetration is rising rapidly, coverage is expanding, but one of the crucial factors is that there is an opportunity for mobile in emerging markets that largely is absent in mature ones. And that is that access to core services, be they in financial services, health, education, or employment, are still enjoyed by a relative minority in many emerging countries. On the other side of the coin, these same individuals actually have a relatively healthy access, if not ownership, to mobile. And marrying those two up means that mobile has a role to play in service delivery through value-added services that have both a social and commercial impact. We think that factor is a key one behind the amount of ICT innovation that has been happening, targeting particularly the mid and low-income groups. And this really is the growth segment of the future that we want to keep an eye on. So turning to the investment challenges, We know that it's a positive growth story with increasing innovations in the ICT sector, particularly in mobile and emerging markets. But we need to ask ourselves the question, if this is going to be a transition to sustainable ecosystems, what challenges need to be overcome? As I alluded to in my remarks on the key takeaways, the first is that it really surrounds what we might see as the nature of capital flow. The chart you're looking at here is again a crowdsourced view of funding direction from one region and to another. The first point to make is that from a positive point of view, more and more capital continues to flow into the ICT space. And indeed, the growth rates for that are very high, particularly in emerging markets, because they're coming off lower bases. The challenge comes from the fact that in key emerging regions, and I would highlight within that Africa, South Asia, and Latin America in particular, most of that increase in capital is coming from investors who are based outside of those regions. You can see in Africa, the vast majority comes from North America. You can see in Latin America, the red shading on its pie indicates that most of that ICT investment is sourced from European investors. Now, of course, that is a good thing in that capital is being provided to high potential entrepreneurs in these regions. But the underlying challenge within that is that if we are looking for sustainable ecosystems, ultimately that will rely on an enabling environment. That would include education, that would include mentorship, that would include business development through a cyclical process. There is a lot of local know-how needed to execute on that properly, and we believe that investors domiciled in the regions where entrepreneurship is being sourced are best placed to provide that. In other words, an increasing number of African investors providing capital for African entrepreneurship, the same being the case in other regions. So that's the first challenge. The second challenge is what I alluded to again at the top, around a lack of seed funding. And if you look across the traditional venture capitalist funding spectrum, right from an idea and prototype stage to an expansionary exit and ultimately public offering stage, there is a funding continuum where across all countries, regardless of whether they are high mature markets with high mobile penetration and high investment, set of decision-making criteria given by investors, risk-return environments predispose investors to think of investments from the point of view of assured return, particularly in markets where rates of failure among entrepreneurs are high. The challenge, though, is that in emerging markets, much of the potential innovation that we see in mobile and the wider ICT sector really sits at that low end, roughly below $250,000 an ask per round, but especially below $100,000. And it's at this stage of company development that it's absolutely crucial capital and mentorship are provided to nurture what are often fragile yet high potential ideas. If that innovation goes unfunded, there is a very real risk that it will go unrealized. The opportunity cost for that is that given many of the target audience these entrepreneurs are seeking to serve are mid and low income, and that these represent the majority of future growth segments, both in entrepreneurship and for the mobile operators, that innovation going unrealized means both those individuals don't reap the benefits from the services that are available, and the capital providers have an opportunity cost in that they've missed the opportunity to provide capital for a service that in the long run will have a higher return. The last point I would make is that this is really something that is accentuated in emerging markets because while there are higher rates of failure, there are also fewer later stage success stories to fall back on, meaning that you have fewer visible opportunities for capital coming in at the low end based on success stories exiting at the mature end. So that's a description of the two key challenges that we've identified in this space. I want to turn it over to Barbara now, who is going to take you through our survey of investors and some of the key findings. I'll return a little bit later to talk about the what next from a stakeholder point of view. Barbara.
Thanks, Tim. So yes, as Tim mentioned, we have identified some investment challenges, and to try to better understand these challenges and what are the differences in funding for different types of investors and what are the drivers of this funding gap, we decided to conduct a survey sampling 33 organizations that have active investments in ICT and emerging markets. These organizations are organized in 3 different groups, 3 different types of investors, donors, impact investors and VCs, and incubators and accelerators. The first results of the survey are on the ranges of investments of these investors. And we noticed from the slide that there's an overlap in funding ranges. However, donors and incubators tend to invest in later seed stage, while VCs and impact investors tend to invest more in growth and expansionary phase. This reflects the risk appetite and motivations of the different groups, as, for example, donors are willing to invest in earlier stages that are more risky, as they are not purely driven by or primarily driven by financial returns. However, since there's an overlap, I would say that a key takeaway from this slide is that there's an obvious funding gap under $100,000 is identified, at least for the most relevant and least relevant challenges. There are no differences between the types of investors. We divided the challenges in 6 categories. You can see them in the bottom of your slide. There's quality of entrepreneur, business model, quality of idea, return of investment, ecosystem, and country risk. The main challenges that have been identified by investors are related to the scalability of the business model and to the lack of experience and exposure of entrepreneurs. As Tim mentioned earlier, technical skills are not considered as relevant by investors, or as considered as a relevant challenge for investors. And interestingly enough, the least relevant challenges for investors are related to the country risk, so political risk and macroeconomic risk. And this is interesting, as usually emerging markets are considered risky countries and this is a deterrent for investors to invest. However, from the survey, we realized that this is not the case. From these results, an obvious recommendation for entrepreneurs and investors is for entrepreneurs to improve their business skills and their business exposure. And from an investor point of view, is to provide a more hands-on approach, so provide skills training and mentorship other than funding, and to take ownership in building a local angel network to increase local investment. So as I mentioned before, in other words, we need to create an enabling environment, so not just by providing funding, by providing education and mentorship. So we have talked about entrepreneurs and investors. However, we believe that there is a role for operators to play in this space. And in particular, in emerging markets, we have seen operators involved in experimenting with innovative services. And through our research and talking to operators, we've identified three main initiatives in which operators are involved. So service delivery platforms supporting and launching incubators and accelerators, and launching startup competitions. So taking these in turn, we see, for example, Telefonica, Orange, and the operators in China have developed a service delivery platform to share their network infrastructure in the different regions where they operate and to attract local developers. For example, Orange in Middle East and Africa has provided an open access to its APIs, exposing SMS, USSD, and payments. APIs provide a common interface for the developers to work with services on the operator's network. So service delivery platforms provide a single point of access to all countries in which Orange operates in Middle East and Africa. In addition, Orange has also launched an API challenge in May 2014 in Senegal, Mali, and Ivory Coast, allowing local SMEs to access their APIs. And the winner received funding and opportunities of partnerships within Africa. The winner was a startup from Senegal that connects farmers to agribusinesses by providing real-time market prices. Going on to the second initiative, we see operators involved in supporting and launching incubators and accelerators. So traditionally, Silicon Valley has been at the center of innovation, as been mentioned before, and operators have established outposts there. However, in emerging markets, operators have decided to launch their own incubator in the local market. And this is important as operators are capitalizing on their local presence and their local knowledge. We see examples of this from Telefonica in Latin America, Redo in Asia, and Orange in Africa. Operators usually provide funding, mentorship, and a working space. And to launch these incubators, operators usually form partnerships, and we see examples like Redo in Myanmar has formed partnerships with traditional firms like Microsoft and Amazon, and less traditional ones like with Red Bull. In Senegal, Orange has partnered with the government to launch an incubator, and MTN has partnered with Rocket Internet in Africa and Middle East to launch incubator focused on e-commerce. The third initiative in which we see operators involved in is launching startup competitions. Orange has launched an African social venture prize, providing cash for up to 25,000 euros, and Safaricom has launched an app with challenge to help developers launch and build their own startups. This has some clear benefits, but as both Tim and I mentioned before, there is a need to provide, especially in emerging markets, not only funding but also mentorship to create that enabling environment. So I think that the conclusion from this is that if we see in Silicon Valley tech firms and internet players that are at the forefront of innovation in emerging markets, it's operators that are increasingly driving this innovation. I will hand back to Tim to talk about other stakeholders.
Great, thanks, Barbara. So we've talked throughout this webinar on what is a positive growth story and what we think will continue to be one. We've highlighted some of the challenges to that, and indeed we have gained responses from active investors in this space, which we hope will act as an impetus to constructive dialogue and ultimately action to ensure that entrepreneurship in the mobile space, targeting predominantly mid and low income populations, continues to be a reality for the foreseeable future. It's important to step back from the discussion, though, to look at what we might see as a wider view. Emerging markets do have a unique opportunity. Both mobile and the internet are experiencing parallel rises in penetration, both due to the ubiquity of mobile phones with their falling costs, as well as the lack of widespread fixed broadband infrastructure. It means that it's well positioned to be the primary gateway to internet access for new users over the next 3 to 5 years. In other words, a coalescence of tech adoption. If we are to see this as realized on a sustainable scale, though, we do need to consider factors beyond the investment and entrepreneurship stakeholder groups themselves to the wider space, which we would include education, the role of private companies, and indeed, perhaps most importantly, government, the public policy environment. A more holistic view to consider multiple stakeholders acting in parallel. When we look at, from a public policy point of view, what works, I think the common denominator, looking through history in Silicon Valley, and indeed to more recent examples in Europe and now emerging markets, that there's really an imperative to provide pro-investment regulatory environment to encourage not only investors from a capital point of view, but to increase the amount of transparency and certainty in the environment with which both they and the entrepreneurs that they are funding operate in. Taking a look at Silicon Valley, of course the success stories are well known, we've touched on those, but it should not be forgotten within that the U.S. government had its own role to play through, for example, the Small Business Act, through capital gains tax relief, through government incremental contributions to private investment, where entrepreneurs, until very recently, for every $3 received from private investors, would receive an additional $1 from the U.S. government. All of that designed to foster the innovation on a sustainable scale. Similar schemes we've seen in Israel, particularly around Tel Aviv, but also in the wider country in the early 1990s with its YASMA program. That may be well known to some of you, but really that had a very definite impact on the amount of inward investment that came through, and the public policy transparency behind that had a big role to play. And while emerging markets are, of course, by definition, they have smaller mobile market penetrations. Within that, the role of public policy cannot be ignored and is every bit as important. We are starting to see more constructive actions being brought to bear. We highlight Kenya in the report through a government partnership with one of the notable local incubators. We're seeing an increased amount of this in China through the Shenzhen ecosystem, through Shanghai. We're seeing an increased amount of it in South Africa, and indeed one perhaps lesser known one just as of the subcontinent in Sri Lanka. All of these are common denominators in that pro-investment regulatory environments must go hand in hand with the factors that we've talked about throughout this webinar, from an investment and entrepreneurial point of view to make sure that the budding innovation hubs that we now see sprouting out across the developing world translate into sustainable ecosystems. So I think we'll end it there from our prepared remarks on the webinar. We'll turn it over back to facilitation for Q&A, so please do send your questions if you have them.
Great. Thank you, Tim, and thank you, Barbara, for the excellent presentation. And I really look forward to delving a bit deeper into these topics during our Q&A, which is up now. Quickly, though, I've had a few people ask already if this webinar will be recorded. So let me just be clear, yes, we are being recorded, and the presentation archive will be shared on the video page of the GSMA M4D Impact site. Also, for those of you physically based in or near London, GSMA M4D Impact will be delving even deeper into this topic on Thursday, August 14th, in a live discussion that will be hosted at the GSMA headquarters. The panelists at that event will actually compare and contrast the financing challenges faced by emerging market entrepreneurs and by UK-based entrepreneurs. So please do email for more information. And if you, before you leave today, if you would kindly complete a feedback survey that I will message to you momentarily, we would really appreciate it. So now on to the Q&A. This first one is from me. In developed markets, especially in the U.S., so by the way, this is based in Silicon Valley, and this question comes from that in part. There has been talk of a Series A crunch, and seed stage funding has greatly increased, but Series A rounds have actually stayed level. So even if there is an increase in seed funding, I guess my question for you, Tim, is do you see an issue like the Series A crunch happening in emerging markets?
I think there is a risk of that happening. As you said, I mean, it's clear that as in Silicon Valley, it's the case in emerging markets that the amount of capital coming in at the Series A level is increasing, and that's a positive story. I think we're less concerned and would therefore highlight less purely the amount of rounds that are happening, and more would focus on where what specific ranges those are being directed to and what conditions are attached to those rounds. Ultimately, that even if you are providing capital at the $500,000 range or below the levels that we have described, be that $250,000 or $100,000, what we would focus on there is really that, in addition to the capital, it comes down to this enabling environment through the mentorship, through fostering local angel networks, educational facilities, to develop that cyclical dynamic, which is ultimately what is needed for investments at the low end to take hold and to scale that into later stages.
Great, thank you. Thank you for the thoughts. So just one more for me, and then I'll open up to our audience as I see questions starting to flood in. I want to make time to get to as many as possible. This next question is, how important is the perception of a given market versus the reality of that market when outsiders are looking to invest? So based on the research that you've conducted, Tim, does the health of the local regional ecosystem play a factor in the investment decision?
Yes, it does. I mean, it's tricky in that perceptions often become reality, even though they shouldn't. But I would dispel a misnomer here that we highlight in the report straight off the bat. Country risk and macro risk, be that political or currency related, is not a deterrent for ICT investment in emerging markets, merely to the extent that other challenges around business experience and the business model are. And why that's important is that it implies that investors have a tolerance for those risks given the potential to be funding high return innovation. Now, to the second part of your question, what's the importance of the local ecosystem in place? Well, again, this is a chicken and egg issue. If investors ultimately need to be at the forefront of developing an environment, a herding mentality where everybody waits for the other to get into that process means we're going to be delayed in actually seeing it come to fruition. So I do think that there is an importance for first movers, for large international donors, as well as for-profit capital providers to take the leap into this space. And indeed, there are organizations, without naming names, doing precisely that, which is very encouraging to see. But really, that to get to a critical mass, we ultimately need to see more. And once we do, and once that enabling environment does start to form, I think the perception from abroad will become less and less of an issue.
Great, thank you. Thank you for that. This next question comes from our audience, and it asks, are there any cases of MNOs setting up angel funds in Africa?
A few, but the vast majority of the capital from operators is really coming in to fund hubs as opposed to necessarily individual organizations or sort of angel style funding schemes. And I think the reason for that is that operators, of course, they have businesses in these markets already. They're deployed with networks and establish employee groups to run that. There are examples that we know of increasing links and indeed formal partnerships between operators and small business and angel-style groups. But the majority of the engagement from an operator view is really seen more at the hub level. And indeed, where there are direct partnerships with service providers, that would be a separate thing through private business contracting.
Okay, great. Thank you. Next question takes us back a bit to the Silicon Valley perspective and asks, what do you see as the main way that stakeholders in Silicon Valley can help accelerate innovation and the growth of self-sustaining global ecosystems in emerging markets? Any particular insight on that point from your research?
Yeah, that's a great question. And just to start off, to reiterate, indeed, looking at most emerging regions, be that Africa, be that India, Southeast Asia, the majority of capital coming into those areas, still comes from North America, and most of that in California and Silicon Valley. So the question, what can Silicon Valley stakeholders do to help drive innovation sustainably in emerging markets? I think that there is sort of two things. One is leveraging on success that's been seen in Silicon Valley. There's no substitute for understanding how to design technology that can be monetized to a consumer base and what business skills are needed to do that. And I do think in Silicon Valley, having visited the region many times, spoken with people on the ground there, that there is a lot of very close interaction between investors and entrepreneurs in that region. But what is different is that when Silicon Valley investors look to place their capital with entrepreneurs in emerging markets, they need to think of that not as purely a portfolio diversification play of funding capital and expecting a rate of return commensurate with the risk. It's much more involved with direct hands-on involvement with those entrepreneurs, and that may involve setting up operations on the ground, which indeed we have seen from several VCs, not only in the U.S. but also in Europe, or indeed franchising that level of support out to a connected group, so that there is a much closer link between the investor and the entrepreneur themselves on the ground in those emerging markets. It's not a relationship that's sort of bound by distance.
Great. Thank you. Thanks for that. I'm noting that there are a few questions coming in that are follow-up questions to those that I've already asked. So what I will promise the audience is that we will, all of the questions that you're asking that we may not have time to get to today will certainly be made available to Tim and Barbara, and we'll ask them to follow up with you to make sure that that all questions received do answer, even if we're running a bit short to get to them today. So let me go to a question from a new individual. This question is asking, can you expand on the alternative way out and related challenges for investors in emerging markets?
Apologies, just before I answer that, could you clarify what is meant by alternative in that sense? I will ask, the individual will ask the question to do that, and then we'll circle back. So let's go to another one while we wait for that. This next question is, how do we get de-advised and donor agencies to reduce the time required to write early stage checks defined by this individual as 100K to 250K, which by this individual's estimation should by nature take less than a typical 6 months that they usually require for all check sizes. Any thoughts on that from your research? Yeah, so another very good question. So, and this is an issue that we have, that's been voiced to us by many entrepreneurs, and indeed, a frustration from some, in the donors themselves. When you are, as you say, looking towards, smaller check amounts, but still taking a lot of time. I think what this comes down to is really a framework for what capital provision strategy is for a donor, and working in a due diligence process that is standardized. So a lot of investors, it's not just donors, it's venture capitalists and impact investors as well, have, understandably a very extensive set of due diligence criteria to run before saying yes or no on an investment. The reality is that this supposed sort of missing middle falls foul of that, given that even though they're smaller amounts, the due diligence it takes just as long, and so it's often not worth the effort to be bumped on it. But ultimately, if donors and these other impact investors are to be able to speed up the process that funding is approved for early stage ventures, I think that there needs to be a realization in those organizations that risk levels are, in the whole risk setting criteria is fundamentally different than it would be for a large organization, and indeed for one in mature markets. And so where there can be efforts to work very closely with potential investees on future monetization strategies and scale strategies, as opposed to a distant, sort of unconnected due diligence process, that will help speed up the process, because you're ultimately working collaboratively towards what, in the end, is hopefully a positive solution. The last point I would make on that is just that there is, we have, again, talked with a number of organizations. I think there's an impetus from large donors to have effective, how to put, sort of searching or market overview strategies to understand where potential plays are and how that fits into their investment strategy. In other words, you will be able to zero in on potentially low risk possibilities from an early stage. So those that you do go to due diligence with and closer examination are automatically the ones that you're more likely to fund anyway.
Great. Thank you. That's clear, and I think a really great point. I think we have time for just one more question. So let me ask, from your perspective, this comes from our audience, what are the most important results or takeaways of the survey from the entrepreneur's perspective in an emerging market?
So I think I'll reiterate the point that Barbara made in the presentation. There is a wealth of great ideas, of very innovative propositions using software, using mobile, to reach an audience that has largely been underserved so far. There's no problem with that, and that is going to continue. I think what we're looking at here is really, though, a mentality shift where for entrepreneurs, it's very important to put themselves in the shoes of potential investors and indeed other partners, so that when pitches are made, be that to an operator, or be that to a donor, or be that to another type of investor, that those pitches are made in a targeted fashion and understanding the pain points with that potential investor. And so that places the incumbency upon the entrepreneur to have very clear business plans, very clear projections, very honest and transparent recognition of the risk factors within that, and ultimately contingency options. And that links back to that point I made on the previous question of due diligence itself being much more of a two-way street as opposed to a let's go and explore the book mentality, which is the traditional mode of that happening for investment in Western markets. So I think it's all of that wrapped up into a very sort of clear understanding from entrepreneurs that there is a lot of capital waiting to be placed. That isn't the issue. It's that you need to approach potential investors with clear plans of sustainability and how to monetize that.
Great, thank you, Tim, and thank you to the audience for all of the great questions. I know there are a few follow-ups, as I mentioned, and more specific questions that we've run out of time to get to, but we'll make sure that all of you get proper follow-up to get the answers to all of your questions. So on behalf of Vital Aids, it's really been my pleasure to host today's GSMA for Development Impact Research Webinar Series. Thank you to my presenters and to all of the attendees for their time. We hope that you'll join us in the future. We'll be sure to make you aware of the upcoming events that we have planned in this series. A friendly reminder to please complete the feedback survey, and if you are so fortunate to be in London, please do join us for the coffee house that's scheduled on August 14th. Thank you, everyone.